How are things now? My name is Paddy, and welcome to the 8th episode of my podcast, Finding Cashflow. On today's episode, I want to focus in on G7 government debt. And this is a topic which we got into quite a lot in the last episode of this podcast also, even though the last episode was supposed to be solely based on the population growth in Canada throughout time. But I got sidetracked by talking about bond markets once again, because I believe that it is bond markets which are the most important financial markets in our entire global economic system. In fact, I asked ChatGPT before recording today, what is the most important financial market in the world? And it said that it is, without doubt, the US Treasury market. And it has been for this reason that the primary focus of this podcast so far has been on bond markets and treasury markets. In fact, every episode that we've done has either been based on bond markets or been based on markets very closely related to bond markets. For example, in episode 1, where we looked at the cash flow of a residential real estate investment property here in Canada, the cash flow of an investment property is very heavily based on mortgage rates, and all mortgage rates across the world are based on what happens in the bond markets. Or in episode 3, where we looked at equity markets, and we looked at the valuation of equity markets, and specifically the S&P 500. And we looked at their valuation as determined by their PE ratio, by their price to earnings ratio. And then in episode 4, we went on to talk about why the PE ratio is important by talking about the earnings yield, which is the E over P, or the inverse of the PE ratio. And we compared the earnings yield of the S&P 500 to the risk-free rate, or the risk-free yield, which once again comes from the bond markets. And I will finish off this episode by going back to look at a graph that we've looked at many other times during this podcast, which is the graph which I believe best explains where we are in our current economic cycle and best explains where we're likely to go from here in our current economic cycle. But before I get into any of that, I want to first bring up a graph which we looked at in the last episode, where we did look at the population growth in Canada throughout time. Because unfortunately, I made a few mistakes in the labeling of the data in one of the graphs, and I want to go back to ensure that I clear up any confusion that may have been caused by that mistake. So I'll first look at a graph showing our births and deaths in Canada throughout time. So here we have a graph of the births and deaths in Canada going back to the early 1970s. Now, I had labelled the green line and the red line as the birth rate and the death rate, but this was incorrect. The green line and the red line is the amount of births and the amount of deaths in our country each year. And once again, we can see that the amount of births that we have in our country each year has remained range-bound going back to the early 1970s, staying between 350,000 and 400,000 births per year. And we can see that the amount of deaths that we have each year has risen substantially over the same time frame. But now we must consider the fact that the population of Canada has also changed dramatically over this same time period. The amount of births in our country over the last 4 decades has been reasonably stable, but the birth rate has declined substantially. We are having the same amount of babies each year in our country, despite the fact that we now have far more people living in Canada than we had in the early 1970s. On the other hand, the number of deaths that we have in our country each year has risen substantially, even though the death rate has been reasonably stable. People are dying at the same rate, but now we have far more people in our country than we had a number of decades ago, meaning that we now have far more deaths each year. Here we have a chart from Statistics Canada showing the total fertility rate in Canada over the last 100 years. This chart shows the average number of children per each woman in our country. We can see that the fertility rate, or the birth rate, peaked in the 1960s and has been declining ever since. It was in 1960, which is the year in which the contraception pill was first sold in our country, that was the turning point for the fertility rate. And in the early 1970s, we fell below the replacement rate, which is set at 2.1 kids per woman. This meant that we were no longer having enough kids to sustain our population. And this is why we've been depending on immigration over the last number of decades in order to sustain population growth in Canada. We can see major historical events also included in this chart. We can see the Great Depression between 1929 and 1939 shown in the first light blue shaded area. And we can see that the birth rate dropped substantially over this time. Then we can see that once the Great Depression was over, the birth rate rebounded substantially, even during the years of World War II. All of the other major historical events noted in this chart are recessions, and they're denoted by the grey shaded areas. In the last episode, we looked at how recessions affect the amount of births that we have in our country, and we looked at the 1990 recession as well as the 2008 Great Recession in particular. And then, just to confirm what's happening with the birth rate and death rate, I took the data for the amount of births and deaths in our country each year from StatCan, and I combined it with other data from StatsCan showing the overall population in our country in each year. I was then able to calculate the amount of births per 1,000 people and the amount of deaths per 1,000 people in our country each year. And we can see, once again, that the birth rate is falling substantially, going from 16 births per 1,000 people in 1972 to 9 births per 1,000 people in 2025. And I was able to calculate that the percentage drop was perfectly consistent with the percentage drop in the amount of children per woman from the last chart. I will often compare different data sets in this way, especially when I'm compiling data myself like I have in this instance, to ensure that my findings are correct. Also, we have seen that the death rate has been very stable all throughout this time. And we would expect to see this, as people can choose not to have children, but people can't decide that they're not going to die. So now we can see the total change to our population growth, which is shown by the blue line, by adding up its various components. Once again, we can now see that we have little change to our population growth due to natural causes. This is now due to the fact that we almost have as much deaths each year in our country as the amount of births, and this is shown in the green line. We can also see that we've had a doubling in immigration coming to Canada over the last few years. Immigrants, in accordance with StatsCan, are people who come to Canada who already have permanent resident status, and we can see this denoted in the red line. And then we can see that we have had an unprecedented explosion in non-permanent residents. These are temporary foreign workers and international students, and these can be seen in the orange line. And the result of all this has been record population growth in Canada in 2022, 2023, and 2024. We brought in, on average, over 1 million people into our country each year across these 3 years. And this is why I believe that we've had such a substantial housing crisis in our country over the last 3 years. By bringing in, on average, 1 million people a year for the 3 years between 2022 to 2024, combined with the fact that we'd be doing very well to deliver 250,000 new homes to our housing supply in any given year. We know this from episode 2 of this podcast. So the interaction of supply and demand for new housing was just completely out of whack. We were bringing in far more people into our country than we were able to house. But now we're in a completely different environment. Now we're in our first year of 2 back-to-back years in which our government plans on us having zero population growth. And this is happening at the same time where I predict we're going to have an all-time record for new home completions in this country, maybe this year and next year. And even if we don't break our all-time record for new home completions this year and next, we're certainly going to have 2 years of extremely elevated amounts of new homes being brought to the market. So that begs the question, who is going to live in all of these new units that we're going to be completing? In essence, I believe that the housing crisis that we speak about is an issue that we had in years past in Canada. I believe that we actually have the opposite issue now. I believe that we're going to be delivering more new homes than we have people to fill those homes. And I believe that we are very much underestimating the negative impact that zero population growth will have on both our housing economy and our overall economy in Canada. So now, finally, to get into the topic of this episode, and let's look at G7 country government debt. And it's not just the size of the debt that's the issue, it's the carrying cost of that debt. Just like your monthly mortgage payment is not just dependent on the cost of your home, but it's dependent on the interest rate at which you got your mortgage at. The carrying cost of the debt for these countries is not just dependent on the size of their debt, but it's also dependent on the interest rate at which they'll be paying down this debt. Essentially, it's dependent on the bond yields of these countries. So let's now go back and look at the 30-year bond yield charts of the G7 nations. And we will see that these yields have risen substantially over the past few years. In fact, the majority of these yields are at highs not seen in the last 15 years. And the UK and Japan are at yields not seen this century so far in both of those countries, with yields in Japan in particular being substantially higher than at any other point this century so far. Yields being so low for so long in Japan is what made the yen carry trade so popular. Yields have also risen substantially here in Canada over the last few years. So why are the rates of all these G7 nations going higher? Well, to answer that question, let's go back and have a look at the composition of a bond yield. And let's first look at the composition of a treasury yield. A treasury is a bond which is issued by the US government. Treasury yields comprise of the Fed funds rate, which is set by the US Federal Reserve, plus future inflation expectations. We must then account for a term premium, and this is only applied to longer-term Treasury yields, and we'll explain why this is in just a few moments. We then need to add a liquidity premium. A liquidity premium compensates investors for the risk that they may not be able to sell or liquidate their bonds for a fair price at short notice. And this liquidity premium is usually higher on longer-term treasuries, as they are typically harder to sell. And finally, when we consider bond yields, we must also account for a risk premium. A risk premium isn't commonly included in treasury yields, as they are seen as a risk-free investment, as it is believed that the US government are guaranteed to pay their debts. So these are the components that make up bond yields, and if any of these components individually were to increase or decrease, this would cause the overall level of the bond yield to increase or decrease. So let's now look at each of these components more closely, starting with the central bank's policy rate. So why would the central bank raise or lower its policy rate? To answer this question, let's put ourselves in the shoes of a central bank. When putting ourselves in the shoes of a particular person or entity, it becomes much clearer why they would act in a certain way or whether a certain outcome from a situation might be a benefit or a detriment to them. So in this instance, we are the central bank, and we have two extraordinary powers. We can raise or lower interest rates, and we can literally print money. And, as you can imagine, our primary goal is to protect and maintain these extraordinary powers at all costs, despite pressure from the President of the United States or anyone else. So what will reduce the importance or value of these extraordinary powers that we possess? Well, our powers allow us to control money supply, and the one thing that devalues money is inflation. So as a central bank, our primary goal is to fight inflation at all costs. And we can do this by raising interest rates as well as quantitative tightening, which is essentially the opposite of printing money, as it decreases the money supply. And we have seen all of the G7 central banks raise interest rates over the past few years in order to fight inflation. And this has substantially contributed to the higher bond yields seen in each of these nations. Next, we have future inflation expectations. A rise in future inflation expectations causes investors in the bond market to demand higher yields when investing in bonds. We went through exactly why this is in episode 5 of this podcast, when we looked at how the interest payments which Amara will pay us back at the end of each year, as well as the principal which she will pay us back at the end of the term, will be worth less if future inflation expectations are higher. Remember, inflation decreases the future value of money. So, if inflation expectations are higher, we, as investors in the bond market, will demand to be paid higher yields when loaning out our money. As we remember from episode 5 of this podcast, we are an investor in the bond market when we have money that we would like to loan out, either to a government or to our company. This is us with our $100 at the bottom of the screen. Amara is the person or entity who would like to borrow this money from us. Therefore, Amara will be the issuer of the bond, which is essentially an IOU. Amara would like to borrow our money for a period of 10 years, so 10 years becomes the term of the bond. And the coupon rate, or the interest rate in this instance, will be 4.5%. So in this example, Amara will pay us $4.50 at the end of each year for the entire term of the bond, as well as paying us back our initial principal of $100 at the end of the term. Next, we will look at term premium. Bonds with longer terms or maturities contain a term premium. This is because we have a better idea of where the central bank's policy rate, as well as inflation expectations, will be in the short term, compared with points in time further into the future. So, the term premium compensates investors for the risk that the policy rate and or the inflation rate will be unexpectedly higher at certain points in the future. It compensates us, as investors in the bond market, for the uncertainty of what the future may hold. This is why a normal yield curve contains higher rates for longer-term bonds than it does for shorter-term bonds. In episode 5, we looked at normal yield curves as well as inverted yield curves. And we mentioned how inverted yield curves are commonly seen as an indicator of oncoming recessions. And we asked ourselves, why would investors in the bond market demand higher rates on shorter-term bonds versus longer-term bonds if they believe a recession is oncoming? In order to understand the bond market fully, it is very important that we understand the answers to these questions, and we will delve further into this in future episodes. We then have liquidity premium, which compensates us as an investor in the bond market for the risk that we might not be able to sell our bond for a fair price if we find ourselves in a situation where we can't hold on to the bond until maturity and we're forced to sell. Finally, we have a risk premium. US Treasuries don't contain a risk premium, as loaning out money to the US government is seen as a risk-free investment, as it is believed that the US will not default on their debts and that they will always be in a position to pay their investors back. However, loaning out money to other bond issuers isn't always seen as a risk-free investment, and a risk premium must therefore be included in the yield we will demand as an investor in the bond market when loaning out our money to different entities. Here, we have two people who would like to borrow our money from us. In this example, Amara is the US government, and we are extremely confident that the US government will pay us back our money if we were to loan it out to them. Breda, on the other hand, is a company who is trying to raise capital in order to buy a chain of retail stores similar to Hudson's Bay. If uncertainty regarding the economy were to rise, we may not be fully confident that loaning out our money to Breda is a safe bet, and the extra 0.5% in interest which Breda is willing to pay us may not be enough to compensate us for taking on this extra risk. Because of this, Breda may need to offer us a 7% interest rate in order to entice us to loan out our money to her. The difference between 7% and 4.5%, where 4.5% is the risk-free rate, is 2.5%, which is the risk premium in this example. As mentioned already, Treasury yields, which are bonds issued by the US government, don't commonly include a risk premium. However, this may be changing. And this would be because of the US government's fiscal situation, because of its income and expenditure statement. The US government has been running a deficit for years now, meaning it is spending more than it earns each year. And because of this, investors in US Treasuries may be starting to include a risk premium in the yields that they are willing to buy US Treasuries for. Ray Dalio also believes that we are likely to experience a supply and demand imbalance or problem when it comes to US Treasuries. Essentially, Ray is concerned that despite robust demand for US Treasuries, he is concerned that demand will simply not be able to keep up with the inevitable increase in supply. If the supply of any asset or commodity outpaces demand, this causes prices to fall. And when bond prices fall, their yields rise. So this too could put upwards pressure on bond yields. And as the US government is still seen as the safest entity in the world to loan money to, with US Treasury yields determining the risk-free rate, if this risk-free rate were to rise, i.e. if US Treasury yields were to rise, this forces a repricing in yields globally, not just for other countries, but also for companies through higher corporate bond yields, as well as higher mortgage rates for households. We looked at this phenomenon in the last episode, when we looked at how the peak in US Treasury yields in October of 2023 caused the bond yields of all our G7 nations to all rise at the same time. And why am I concerned with higher bond yields? Well, higher bond yields means that the cost of borrowing goes up for everybody. For governments, for companies through the issuance of corporate bonds, as well as for households who are forced to pay higher rates in their mortgages and credit card debt. These cycles are explained better than I could ever possibly explain them myself by Ray Dalio in this YouTube video named How the Economic Machine Works. This is a very clear and well-explained video with very helpful and simplistic illustrations, many of which I have borrowed for this podcast. And I would recommend watching this video several times, and not just to listen to it, but to watch it and follow along with the illustrations. For me, the concepts in this video became clearer and better understood the more I watched this video. And the concepts explained by Ray Dalio in this video, as well as in the books that he has written, seems to line up perfectly with this chart that I have used all throughout this podcast as being the chart which best illustrates where I believe we are in this economic cycle. It has long been my belief that all recessions are preceded by a substantial rise in interest rates, and oftentimes rates will have already begun to come down before the recession begins. And it is due to the fact that we have just come through one of the most substantial rate hiking cycles that we have seen over the last number of decades that I believe that tougher times lay ahead for both our Canadian economy as well as for the global economy. So this doesn't paint the most rosy picture for the outlook for a global economy. But I'm not trying to have any positive or negative bias when I'm looking at this data. My goal is to look at the data in the most unbiased way possible and then to make my investment decisions based on my conclusions. And when investing, my goal is always to be invested in the assets that I think will give me the best returns 12 months from now, while always ensuring that I'm not overly exposing myself to risk. There is a book behind me on the shelf here called The Compound Effect, and compound interest is really the holy grail of investing. It means that if we can grow our portfolio by a healthy percentage consistently year on year, that over time the effects of compound interest will mean that our portfolio will be growing exponentially. So at any given point in time, I'm always invested based on where I think the economy is now, as well as where it's going over the next 12 to 24 months. And if you'd like to continue to follow along as we continue to discuss global macroeconomic as well as Canadian specific topics, please like and subscribe, and we'll see you all again soon, hopefully.